Well, what I'm going to talk about today is the impact of COVID-19 over 2021 and the outlook for beyond. I've been studying this subject now ever since COVID-19 started. I've written several pieces on this, and I must say it's ever changing, but some things have remained quite stable, as Van pointed out, and I'll point those out as well. Next slide, please. As I've said before many times, in order to understand what happened during COVID-19 and now to try to figure out what's going to happen beyond, we must first look at what was the situation before we started. We were in a benign credit cycle. We are in a benign credit cycle now. It's kind of ironic that we were where we were before, and now more or less, from a credit standpoint, we are in a similar situation. I asked way back in 2019, were we vulnerable to a downturn? And now we can ask the same questions, although all the market indicators are indicating that the benign cycle will continue at least for another 12 months. We're going to talk about the global and US corporate debt buildup, which has been exacerbated by the unintended consequences, perhaps, of the government actions, the central bank actions. And now we are looking at a situation that I'm absolutely confident we are again looking at a potential debt bubble. At the same time, I'm not saying we are in a burst bubble, not even close to that. But we have all the ingredients for us to be concerned. I'm not going to talk about the BBB rating growth. That's already well known. And by far, BBB rated securities debt from banks as well as from capital markets are at record highs, and the BBBs are by far the most dominant rating class in terms of dollar amounts outstanding. I will talk about some new research dealing with the concept of global zombies. And that is something that is perhaps something that's been happening for maybe a decade or so. The importance of it, the growth of zombies in economies around the world, and our new research in this area is just about finished. And when we have that, I'll be happy to make that available to others who are interested. After COVID-19, it's pretty well known what happened. Van talked about March 23rd. It was the beginning of what has continued ever since. The benign cycle ended at first, and then, of course, came back to us. Fed congressional actions, the great market rebound, and I'll have some comments about that rebound and what does that potentially mean for investors and also for corporations, their corporate treasury function, their target debt equity ratios. We'll talk about defaults and bankruptcies in 2020, 21, and our forecast going forward. Importantly, we're going to talk about how recovery rates, if there have been defaults, have been exactly as we had predicted, given the default rate cycle we are in. Okay, next slide, please. Let's move to some of the more tangible factors. You may have seen this before from work that I've done. This is the global debt situation categorized by non-financial corporates, governments, financial sector, and the household sector. In 2020, we have moved much more aggressively globally in terms of increasing debt during a pandemic, during a recession and now subsequent to that period. Indeed, on the right-hand side, you could see that in 1997, a little bit more than 20 years ago, global debt was 217% of GDP, global GDP. It's kind of like a debt cash flow ratio for the global economy. That has moved to 336% in 2020. Close to $300 trillion of global debt outstanding. And that ratio has gone now in 2020 for corporates in particular to over 96% of corporate GDP. So debt to GDP is almost 100% for non-financial, for government. The financial sector, while it has not increased nearly as much as non-financials and government, it's kind of ironic what's happening. The amount of deposits in global banks has skyrocketed dramatically in this low interest rate period. People's savings are at all-time high levels because regulation says that banks must hold a certain percentage of their total liabilities in long-term debt. Banks are issuing long-term debt like never before. Not because they want to, but because they have to. So is this an unintended consequence of government regulation? I believe so. Although banks in general are in pretty damn good shape, as you all know. Household in the US is doing fairly well, but globally that's still a big concern. Altogether, in my opinion, a great deal of the GDP growth of the world over the last 20 years has been on the backs of low interest rates and increasing debt. I don't think this is sustainable for the long term. In the short term, yes, interest rates are low, so who's afraid of debt? But what happens if interest rates rise, as many of us believe is likely to happen, given the inflation situation, which I'll come back to, and given the fact that some economies are not experiencing the growth that they had expected. Just check today's newspaper about what's happening in the US. And what's happening in China is another very concerning situation because they have, as you all know, based on 3 or 4 factors happening at the same time, are beginning to experience much lower growth than they expected and what the world expected. I'll come back to China in a little bit. Next slide, please. Interestingly enough, in 2021, the amount of debt that's been issued has accelerated dramatically from non-banks, the so-called shadow banking system. Indeed, if you check the chart on the right-hand side, you can see that in 2021 so far, that the amount of debt issued by non-banks is more than twice as much as banks in the United States. And that's in the corporate sector. That shows the incredible growth of BDCs and others issuing debt. Of course, they're less regulated, and therefore that debt has accelerated dramatically, adding to the corporate debt situation in the United States. And indeed, it's happening in Europe as well. And of course, in China, where a lot of debt is issued by non-banks. It is a concerning issue if that debt needs to be refinanced at much higher interest rates. Next slide, please. With respect to the market that I love the most, the high yield bond and leveraged loan market, you can see that 2020 was a record year. You probably all know that now, and Oleg Malentalev from Bank of America will be commenting on that sector, I'm sure, later on. Oleg and I have talked many times about the huge increases in high yield bonds. We're expecting this year on the right-hand side to break the all-time record for high yield bonds. Probably over $500 billion will be issued. We're already at record levels through October, most of October. And also the leveraged loan market is well over $500 billion issued this year, near record levels as well. Next slide. Let me pause for a second with respect to talking about the amount of debt that's been issued and talk about perhaps some possible outcomes from the financial developments that we've seen prior to and during COVID-19. Let's talk about fixed income investing for a moment. There's no question that the low interest rate environment has driven investors to take more risk, to seek higher returns. And one area of doing that, of course, is high yield bonds or leveraged loans, CLOs. They're all booming and have done so ever since the pandemic started, or almost from the very beginning. One possible outcome for this trend is to institute something which I call a quality high yield approach. It's no secret that in today's market with low interest rates, investors are seeking the highest yield possible that they feel comfortable with. And I agree with that. So to focus on above average promised yields makes sense, as long as you can control the default situation. Right now, there's very little concern with defaults going forward. We expect that the default rate this year in high yield bonds will be one of the lowest we've ever seen in the history of the market. Right now, it's probably about 0.4 of 1%. It might go to 0.6, 0.7, who knows the exact number, but it's going to be below 1% more than likely. Well, that's okay. Everybody seems to have their guard down because defaults are so low. That's not going to continue for the long term, certainly, or the intermediate term. Short term, perhaps. We'll talk about that. One suggested idea in this possible outcome is to focus on above average promised yields and to seek strategies, models, indicators that will reduce defaults or eliminate it. There's no better way to get higher returns than invest in the highest yielding, whether it be bonds or loan, if you're not concerned with either downgrades or defaults. And that goes for the investment grade sector as well. Let me say something about capital structure of companies. Stock markets are at all-time high levels. Every day it seems that the S&P is breaking a new record. Many people think the market is tremendously frothy, but it continues to grow. It almost seems like with so low returns from fixed income, it's the only party in town. Well, I remember when I studied corporate finance back in the 1960s, there was this concept called opportunistic investment and financing. That means take advantage of low interest rates when they are and build up your debt, and take advantage of equity markets when the equity market is frothy. Well, you might ask the question, isn't it now time for companies to start issuing equity in large amounts when stock prices are high? And yes, they've taken advantage of those low interest rates. So one possible outcome, and I think it's happening to some extent, but perhaps not as much as could happen, is that the target capital structures will again move toward equity financing. After all, Now's the time to do it if, in fact, the markets are going to turn south, or if the firms have built up their debt long enough. So these are just possible outcomes. There are some indications that it's happening already. Let's see if it continues. Next slide, please. How to tell where we are in the credit cycle? Well, maybe this is old news now to many of you, but let's go over the 5 indicators that I look at when I'm trying to determine where we are in the credit cycle, and also talk about what's happening in the default and recovery area. The historic average on high yield bonds is around 3.3% per year, measured in dollar terms. Currently, as of the 30th anyway of September, the rate of defaults, depending on who's measuring it, is somewhere between 0.3 and 0.5 of 1%. Perhaps the forecast for the year is 0.6 to 0.8, and that's probably optimistic. Now, optimistic, I shouldn't use that term, but that's probably high, given that it's so low through the 3rd quarter. At any rate, it's way below historic average, so that implies a benign cycle. Recovery rates are at almost all-time highs, if there are defaults, at around 60% for corporate bonds and much higher for loans. And as a result, if you look at, and I'll show you that slide in a moment, what one would predict about recovery rates given default rates, we're spot on to what all the models that I've worked on have predicted. The required return by investors is now below 3% as a risk premium measured on a yield to maturity, and a little above 3% measured on a option adjusted spread. Historic averages are well over 5%. The benign cycle is clear that investors are willing to take much lower returns on high risk instruments than historically. It must mean that they're predicting low defaults, high recoveries for quite a long time in the future. But is that rate of return really so wonderful? Well, it looks pretty small to me, and of course these are averages. So one way of doing higher returns is to take even more risk, which presents the scenario that I've talked about before. Distress ratio. In 1990, we came up with that term to look at high yield bonds that are trading more than 10% above the risk-free rate. Historically, about 10% of the high yield bond market trades at around 10% above the risk-free rate. Today, it's under 2%. And it seems to be under 2% for quite some time. What does that mean? It means, again, investors are not very concerned about defaults of companies, even the higher risk companies in that market. Liquidity is ample and has been ever since March, April of 2020, incredibly so. But as we all know, liquidity can change overnight. At any rate, put them all together, we are in a benign cycle, and we are likely to be in a benign cycle for at least another 6 to 12 months. At least that's what the markets and the models are telling us. Harry Mamusky will probably talk more about the KBRA model with respect to subsequent default rates and recovery rates. Now, next slide, please. This is the one you've probably seen before, and it looks at non-financial corporate debt as a percent of GDP and the subsequent default rates in the red dotted line. Every time we've had a peak in debt to GDP, we've had a subsequent peak in default rates. Well, that peak occurred in 2020, and we had a big spike in default rates in 2020, particularly on larger companies, not on small and medium-sized firms. which is kind of ironic given the fact that usually SMEs suffer during a recession more than the big ones, but it didn't happen last year. And of course, the default rates have come down dramatically since. We are still at near record levels of non-financial corporate debt to GDP in a low interest rate environment. But many of the indicators now are that those interest rates are going to rise. While I don't forecast interest rates, the pressures there are there because that inflation rate in the United States and in other parts of the world has not been temporary, as the regulators have all predicted. I participated in a session early this week, and the ECB was also getting more concerned about inflation than they had been up to now. And of course, the US Fed is doing the same. The consensus is now that the likelihood of higher inflation going forward is turning in that direction much more than it's been, and the Fed will likely raise interest rates according to the future markets. We'll see about that. I mean, the Fed is very in a tough position because to raise interest rates may signal a change in policy that the markets will not like. We'll see what happens. It's a tough situation right now in that respect, but interest rates remain quite low. 10-year treasuries under 1.7%. Next slide. Let's talk about default rates now. Now, some crazy people out there forecast default rates. I'm one of them. Rating agencies like KBRA and others, and certainly the investment banks. Everyone, including myself, have reduced our forecast for default rates going forward over the next 12 months. And you can see that on the right-hand column, where the base rate as of June 30th of this year had a consensus of under 3% for the next 12 months. I've updated mine, and you'll hear KBRA's very soon, but I have not had the time to survey all the others who forecast default rates. I would guess, and this is an educated guess, that if you asked every one of them, they would all say they are considerably lower than they were even 3 months ago when they lowered their rates twice from what they felt was going to happen at the beginning of the year. We're all scratching our heads. Why have default rates been so low? Well, it's mainly liquidity and the fact that even the most risky companies, excuse me, are able to raise funds. And the clever bankruptcy lawyers out there have all but eliminated Chapter 11, except in some unique cases. Now, is Chapter 11 dead? I don't think so, but it certainly is not prospering, so to speak, from the number of companies that you would expect in this uncertain world we're in. But most people, and I agree with that, think that the default rate going forward is going to remain quite low, at least for another 6 to 12 months. I'm more concerned with the second half of 2022 into 2023, especially if the growth rates in global economies like the US and China do not materialize nearly as much as expected and interest rates rise due to inflation. I think then we're in a completely different situation than we are in today. Next slide. In terms of bankruptcies, so far in 2021, there have been 58 companies in the US with $100 million or more of liabilities. If you extrapolate that, it'll be something like 75, which is an average year. But those are larger company bankruptcies, and they are not necessarily going to be anything like the average year in terms of default rates. billion-dollar bankruptcies are also, there are about 14 so far this year, and that will come in slightly below the historic average, much lower than 2020. A much more benign situation, but not completely out of existence as some people perhaps feel. There's no question that the restructuring industry is not having a banner year. A lot of companies are restructuring out of court through distressed exchanges, or they are simply getting new financing. That's going to probably continue unless there's a shock to the system that we have not factored in yet. Next slide. Let's talk about default rates. Now, this slide here shows you the correlation, if you will, between defaults and recovery rates. Notice on the left-hand side at the bottom, you have default rates between, say, 0 and 2%. If you drew a vertical line from under 1%, you would see that the recovery rates will be close to 60%. And that's exactly what they are so far this year, albeit with relatively low recoveries. So let's more or less feel pretty certain that by the end of this year, the recovery rate, that is the, I look at the price of the bonds selling just after default, will come in more or less as we expect at around 60 cents on the dollar for corporate bonds. Probably over 70 cents on the dollar for corporate loans that default. That means the loss given default is extremely low, which of course we expect in low default rate environments. But the double situation of low default rates and high recoveries is causing the market to be tremendously optimistic about the future. And as a result, I think they underestimate the potential problems probably in the second half, and particularly among smaller and medium-sized firms that will no longer be as protected by the Fed as they are at this point. Next slide, please. The last topic before we go to the Q&A that I'd like to discuss with you is some new research in the area of zombie firms. The following questions can be asked. What is a zombie? Are they important? Is this a problem or not? How best to measure zombies? I'm going to present to you some ideas on what we call a dual filter approach. And finally, let's talk about the zombie incidents in the United States in particular ever since 1990 and through this year. Last year, the data we have up to now, and we don't have 2021 data as yet. What is a zombie firm? Well, there are various takes on this, but basically it's a firm that's being kept alive almost artificially or by outside forces rather than their own ability to survive on their own, such as regulators, such as banks themselves, investors. You probably know that there was a lot of companies in the world that have been kept alive through moratoriums on interest rates in certain countries, like particularly Germany, Italy, and many other European countries, or even an outright ban on bankruptcies in some countries. Well, obviously, if companies would have gone bankrupt and they are prohibited to do so, they are staying alive when normally they would have become insolvent and liquidated or had to be restructured. Now, keep in mind that when a zombie firm or when a firm goes bankrupt, it's no longer a zombie. So with the lack of bankruptcies out there, there probably are a lot more firms potentially that are zombies. Is this important? Well, the major economic argument why zombie firms are important is if they are inefficient, unproductive, but the economy keeps them alive either through regulation or banks not wanting to write off the loans or investors irrationally putting money into these companies or bidding up the stock price on companies that have little chance, at least by most indications, to succeed in the future. Then, of course, you have problems of misallocation of resources in an economy. On the positive side, it keeps employment at a higher level. Employment situation doesn't seem to be an issue in countries like the United States now with relatively low unemployment rates, although we do have a misallocation in some areas of not enough workers, and that, of course, is putting incredible pressures on wages. And those wage pressures, by the way, if I might add a commentary, in my opinion, are not going to go away very easily. Labor is a factor of production that doesn't, and cost, that doesn't change that quickly. And all the impetus seems to be on increasing labor costs going forward. Supply chain problems we all know about. Will they be handled quickly? I don't think so, but perhaps in the not too distant future that will get under control. But it's the labor situation that concerns me the most about inflation. At any rate, zombies, if they're kept alive and people keep working, do add to the employment situation in countries. Maybe some strategic companies are kept alive for many, many years. Alitalia was kept alive perhaps when they shouldn't have been. Now they're gone finally, so that's a zombie that is no longer a zombie in our estimation. How best to measure zombies? Well, let's talk about how most research defines a zombie firm. Next slide, please. Most research on the zombie issue looks at the cash flow of a company relative to its interest. If it's less than one, in other words, they don't make enough earnings, some people use earnings, some people use EBITDA, cash flow, but if they don't make enough earnings over, say, a 3-year moving average period, then these firms should probably not continue, but if they do, for whatever reason, they are considered zombies. I personally think that that's much too liberal of a definition, but let's take a look at what that definition means in the United States. So, the zombie ratio, if you look at cash flow to interest less than 1 for a 3-year moving average, has fluctuated above and beyond 20% ever since 1990. In other words, and these are listed companies, and you can see the number of listed companies in the bar graph there, ranging from a little under 3,000 to a little over 5,000 over this 30-year period. So 20% would be a definition, and it's pretty constant over this period. To me, that's, again, much too liberal. And why is it constant? Well, companies' cash flow have been going up. Why is that ratio staying constant? Well, the simple answer is increases in debt. So if you have far more debt and more cash flow, from depreciation, amortization, and higher earnings, then you're probably going to get, you should get a lower ratio. But it's been fairly constant, currently at about 17–18% of listed companies. I think that definition is wrong. It's much too liberal. There are many companies with cash flows less than 1 have other ways of financing their operation. As long as they're able to raise debt or equity, they're going to survive. I wouldn't call them all zombies, but some of them are. And I believe a dual filter approach makes sense. Next slide, please. This shows the United States from 1995 to 2020. And what we've done here is we have a dual filter approach for what constitutes, in our opinion, and this is from research with Wei Wang and Roy Dai on the subject of zombies. We define a zombie as, yes, where cash flow is less than interest for 3 years on a 3-year moving average, but in addition, for a Z-score, a bankruptcy prediction model that has been predicting defaults and bankruptcy for at least 3 years of companies. So the dual filter approach, using 2 Z-score models, one for private firms, the Z double prime score, non-manufacturers could be private firms, but these are all data on listed companies. So the Z double prime score is a model I built in 1995, not only for the US, but for globally. Very similar results to the Z score, which is for publicly traded companies, listed companies. If you take a look at the combined dual filter approach, interest coverage less than 1 and Z-scores below 0, which indicates in today's market a highly distressed situation, you see that the ratio of zombies in the US has increased from under 6% back in 1990 and as low as 3% in 1993-94 to approximately 10% today. And I think that's a much more realistic figure of companies that somehow are staying alive when without some sort of assistance from regulators, especially during COVID, but also in prior years. You see that these companies continue to exist, either through clever restructurings, even though they are unproductive. So that number of 9–10% is, I think, a reasonable number, and it compares with many other countries in the world. I don't have time today to go through a global analysis, but that's what we're working on in our studies. And we hope to have that paper completed fairly soon. And stay tuned for those results. And finally, let's go to the final slide in my analysis. Some recent observations. Well, I've mentioned many of these before. I still am very concerned with the unintended consequences that the central bank has and the government, by pouring tremendous amounts of subsidies into the system. By the way, I don't deny that those assistants have not succeeded. They've succeeded beyond the wildest dreams of anyone. I mean, anyone. Who would have guessed that the markets would have come back as high as they, as fast as they did, and with such gusto that we are at record levels again in a very uncertain future going forward. But the fact still remains, we have enormous amounts of debt outstanding, which needs to be refinanced. And of course, the big question is, at what rates will they need to be financed in the future? And I'm not just concerned about the United States. If you take a look at Europe in particular, we saw interest rates rising to 6–7% in some sovereigns not too long ago. Could that happen again? It's not likely, with their growth being fairly significant of late, but I am concerned that those debts of those countries also are going to suffer from higher inflation and higher interest rates. Default rates are very low. They're going to continue that way for at least another 6 to 12 months in our estimation. Mega bankruptcies are down. I'm really concerned about the small and medium-sized firm sector in second half of 22, 23, when all the supports go off them, and then companies will again have liquidity problems at that level. I think the SME sector globally is one that is begging for better models and better analytics to deal with the potential increase in defaults going forward. Enormous growth in business formation in the US in 2021. Probably the highest year ever in new businesses, which is, of course, causing traditional business to have a lot less labor available than they had hoped for. Well, what does that mean? Increased productivity? Probably. Increased defaults? Absolutely. We all know that young firms default far more than older firms. A lot of these new companies are just not going to make it due to competition, lack of financing, whatever. Although many of them are getting those, especially the technology firms, huge amounts of new financing. Finally, global zombie firms. Is that a trend that we are concerned with? Some are not. I personally am, if that number exceeds historic levels and governments feel required to keep these firms alive. With that, Dan, I'll end my formal comments. I think we have 5 or 10 minutes left for any questions that there may be. I know that the panels are going to be answering a lot of the questions that people have in mind as well, so I don't want to steal any thunder from what I know will be fantastic insights.
Well, thank you for those remarks, Ed. As always, terrific perspective on this, which are really extraordinary times. I'll remind our audience that you can lob in a question via the navigation bar as we go through this session. But and one that has come in is this idea that governments or central banks can intentionally hold rates low and have a huge incentive to do this because of all the debt that's been created. From your perspective, is it that easy? Is it a switch that gets flipped and governments can control rates to their advantage, or are market forces much more ominous on this topic? What do you think about that?
I don't think they can continually do this with the inflation pressures. Just think of investing in risky debt, let alone investment grade debt, when inflation is 4.5%, and the spreads that you're earning in even risky markets are under 3%. In so the risk-free rate, it has to go up. Otherwise, investors will move their money elsewhere. And moving their money elsewhere these days means equity markets. And that's one of the reasons why equity markets are still doing so well. It's the main game in town. Yes, you can have negative interest rates. Some countries do. But clearly we're having negative real rates factor in inflation. This will put enormous pressure to raise interest rates going forward. Of course, the problem is that if the market visualizes this continuous rise in interest rates, they're going to pull back, and there will be at least short-term carnage in the debt and equity markets. I certainly would not want to be a regulator in today's market. It's just a tough situation. But I think the pressures on to raise interest rates are building. I know the caveat is I'm not a Fed watcher. I've never been trained in that area. I don't have enough time to spend watching them, to be honest with you, but it's just my gut feel that those rates are going to have to be to answer your question, increased due to pressures on the inflation.
Thank you for that, Ed. Here's a question that's come in on the topic of private debt, right? So we've watched a lot of debt get created outside the banking system, very much by design, right? Post the GFC, regulators de-risked the banks. Banks do seize up at times of stress, especially when they're the cause of the stress, as we saw back in the GFC. And a lot of this debt has been pushed out into the shadow banks or the in the private credit markets. So we've watched leverage finance grow, both bonds and loans. We've watched the private debt market grow, I think, less plus to $1 trillion in size. It is now very real. And of course, largely outside of the purview of regulators. How do you think about the private debt market? Is this a good thing because it frees up the banks to step in times of stress and provide financial support? Or is this a worrisome thing because private debt markets can be very fickle? How do you view the growth in private debt?
Yeah, it's a great question, Van. I've had some experience in the private debt sector by building a model that looks at the companies that utilize private debt, and particularly the growth in cash flows and in revenues, year-over-year growth of these, let's say, particularly the medium size sector. I'm talking about firms with EBITDA, up to 75 million, hopefully positive EBITDA. And so the mid section of the country, so far, their growth and productivity has been very impressive, very high. And therefore, the increase in debt that these firms have taken on have been supported by higher earnings and cash flows. If that continues, I'm not very concerned with the non-bank debt sector. What my concern is if there is a big downturn in performance due to macro factors and the leverage that has been built up as a result, particularly on the high leverage transaction firms, the LBOs primarily, the private equity sector. Right now, the private equity sector has average purchase price multiples of around 12 times cash flow. That's the all-time high. And while equity has been used maybe more so than it was back in the 1980s and 90s when there was a big meltdown in that sector, I'm still concerned with the level of debt that's been built up on these high multiples. I do believe we do have a problem in the lack of regulation, however. If this starts showing a problem, will the non-bank lenders cut back on their clients that they've been faithfully, so to speak, and profitably financing over many years? And if they do pull back, then you're going to see a lot of carnage with respect to defaults in that sector. Right now, I don't have too much concern with defaults in that sector. It's the smaller firms I have concern with. And of course, sector by sector, you have to look at that analysis. I think this growth of the non-bank sector is a function of these low interest rates as well. People are looking for yield. And by the way, you can invest in equities in these BDCs and profit by the high interest rates. So they're kind of feeding on itself. But it can turn. And I think it will turn if the growth of earnings and cash flows and revenues in this medium-sized sector begin to be reduced. Right now, some of the work I've done on this with a prominent BDC shows extreme high growth in almost all sectors, but not all sectors. Industrials now I'm a little concerned with in that area.
Yeah, I would agree with a lot of that, Ed. I think from our perspective, the evolution of the capital markets is a positive thing, right? So to the extent you can diffuse that risk broadly, and as you know, these markets are not just U.S. markets; they are really global markets these days. So it's really remarkable. The risk, however, is when there is a turn, when the economy breaks, we do head toward recession. The volatility coming out of that sector, I think, is going to be significant and breathtaking at times. And so we'll see what that looks like at some point in the future. One last question. We've got a couple minutes, Ed, from our audience here. What probability do you assign to the next recession being driven by the stress among or coming out of zombie firms? So again, a weak point in the economy. How do you think about those zombie firms contributing to an economic downturn if that liquidity that you talk about, which supports them, suddenly goes away?
Now, it's an interesting question because there's an irony involved with zombies. If there's a lot of pressures coming from recessions or some other catalyst that we haven't factored in yet, China's, by the way, I'm very concerned with China's growth being maybe 3 to 4% this year, as opposed to what was forecasted to be 6%, because that's going to have a huge knock-on effect on other economies, those that export, German cars, etc., to China. People are just going to buy much less if they see their economy. That real estate sector problem, I think, is huge, even though the government seems to always come up with the ace in the hole and somehow subsidize them. But getting to the zombie area, if we have more defaults, more bankruptcies, that actually reduces zombies. It takes them out of the system, so to speak. And if you have fewer defaults, as we're having now, the zombie issue gets greater. The numbers get greater. It's almost ironic. You have good times in terms of lack of bankruptcies. You have more zombies. I am concerned with that because let's take some European governments that are getting these subsidies coming from the central bank and from fiscals pumping into the system. If they're pumped into zombie firms more than they should be, they're not going to be very productive. And also, it probably, it's kind of another issue, and I'll leave it on this one. One byproduct of zombieism is deflation, not inflation, because those firms need to lower their prices to compete in markets. The bigger firms, the healthier firms, lower their prices, and you have a deflationary pressure. That is overwhelmed now by the inflationary pressures with supply chain problems, with wages, etc. And so it's kind of diffused the deflationary problem. So I'm not as concerned with the zombies causing deflation problems than I would have been if we didn't have this inflation pressures. Overall, I don't think there are any good studies that have shown on a first order, even second order effect, the impact of zombies on global GDP or on country GDP. I wish I had a good answer for that. Most economists would say zombies are bad for the economy rather than good. I haven't seen the projection of increased zombieism on GDP growth going forward in any convincing manner. I think it's a great area for new research, perhaps by someone else than myself. I'm more concerned with measuring it, comparing it across countries, and letting others say, just how bad are zombies for an economy. On balance, I think they're not good, but how bad is something, a first order effect that I really don't have the right answer. At least
Yeah,
not
no,
yet.
I think it's all something that we've got to think through. I think from a policy standpoint, it is an interesting argument in favor of QE because, as you point out, many zombie firms are large employers, and that ultimately, for a lot of government officials, is the first order of business is preserving that. But Ed,
Yeah.
thank you for your comments. Let's stop there and we'll move on. But terrific, insightful work as always. We appreciate it.
Thank you, Van. Thank you all for listening in.
Thank you, Ed.